Welcome everyone. Let me welcome you to the TFI event, the CEPR-TFI event of this edition of the conference. Me and Caroline are actually here in SHoF. We are the only two in Stockholm. But anyway, we are extremely excited that we were able to hold this online as well, and against all odds. So the topic of today is household welfare. Do we need big data? It's a topic that is very close to anyone working in and doing research in household finance. It's close to my heart in particular. It's one of the strategic goals to promote the use of microdata also for the Swedish household finance. And I think it's a very important question, the extent to which we need microdata and big data to improve our societies and our economies. We have decided to focus on what we could possibly do with microdata, why it could be useful. And obviously, we are well aware that the big elephant in the room is confidentiality issues, privacy, and so on and so forth. But we'll not focus on that today out of a choice. Maybe if there is going to be a lot of interest, we can actually organize a webinar on that issue as well. And so we have a fantastic set of a lineup of panelists today that will kind of try to answer this question, household welfare, do we need big data? So let me briefly introduce them. John Campbell, professor at Harvard University, Martin Flodén, deputy governor at Riksbank, Shiler Khedri, global head of data and technology at ANG and Analytics, and then Gianluca Violante, professor at Princeton. We are going to collect, so Caroline and I are going to monitor the Q&A feature of the webinar. So feel free to write questions on that feature. And then what we're going to do, we're going to try to summarize and pick them up during the panel. So we're not going to open for explicit intervention or you to talk explicitly during this event, but we will try our best to collect your questions and your thoughts during the panel. We're going to start with the presentations, 15 minutes each, and then we open up the panel that Carolina, professor at the Stockholm University, Carolina Häggholm, professor at Stockholm University, will moderate.
So yes, thank you very much for getting things started, and apologies again for delaying the proceedings. I will keep my remarks brief in the circumstances anyway. I should just say that we've had a couple of changes in the setup at ING recently. We have created a new department which is called the New Horizons Hub, which I'm heading, and obviously Stefan is along with me in the New Horizons Hub. This does research and curates and communicates about a variety of themes through our own and third-party channels, and we're looking very much at consumer behavior, digital innovation, and sustainability. And obviously one of our activities is leading and driving ING's contribution to the Think Forward initiative, particularly obviously the Research Hub. And obviously we are really very interested in the theme of today, and we've had a number of events over the last couple of years which have touched on today's topic. So 2 years ago we had an event which was entitled Big Data, the Promises and Pitfalls for the Financial Industry. Last year we had an event which was called Man, Machine, Money, which was looking at the intersection of data science and social science. And clearly we've very much focused on this given the digitalization of finance that's been going on at a rapid pace over the last few years. And I think the essential point that came out of a lot of the previous events that we really do need to define the problems that we're trying to solve before we start looking for data. Otherwise, as we put it, we're likely to drown in the data lake. And I think that's also a reason why the Think Forward initiative does believe firmly in a multidisciplinary approach in which sciences, including data science and social sciences, complement one another. So, like Paolo, I'm obviously very much looking forward to today's event, and we've got some really top-notch experts to talk in a moment. Just a quick update on the TFI itself. I'm sure many of you are aware of the fact that this is a multi-party movement, a number of corporate sponsors alongside ING, and obviously we rely very heavily on the CEPR on the research side. We are an open source movement, and we are focused on commissioning new as well as curating existing research. And one other news point that I would like to mention is that we are expecting to turn the TFI into a foundation, hopefully next month. And we have commitments already from the existing partners in the initiative to join the foundation, and we will continue with our talks with other organizations that are sharing our purpose. And I would just like to highlight a couple of points before we move on. One is that we firmly believe in the concept of collaboration within the TFI between researchers and startups. This year's startups have indicated that it helps them tremendously to have the behavioral science expertise that we have within the TFI, and they very much share our purpose in helping people make better decisions. And finally, the TFI will be developing its focus on COVID-19. This is clearly going to be a preoccupation, I think, at least well into next year. And we obviously are very keen to hear your thoughts about how we may take supporting people through this crisis forward as well. So thanks a lot, and enjoy the event.
Thank you very much, Mark. So let's get started without further ado, and I would like Gianluca Violante to start. Please, Gianluca.
Thank you very much. Can you hear me and see my screen?
Yes.
Okay, perfect. Thank you very much for the invitation. I'm delighted to be here and be able to participate to this event. So I want to start with a quote by Eric Schmidt, who's the former CEO of Google, who famously said that a total of 5 exabytes of information was created between the dawn of civilization through 2003, and now that much information is being created basically every 2 days. Okay? And this gives you sort of the sheer size and potential of big data to inform decision processes of individuals, firms, governments, and so on. A potential that I think is enormously untapped until now. So this is all good, and today the focus is on household finance. So I want to basically organize my intervention today around the following question. So why are big data useful to policymakers and for policymaking? And I'm going to try to argue that they're useful for 3 reasons. Ex ante, throughout, and ex post. With respect to this timeline is meant to be with respect to sort of a certain event, like like a crisis or a recession, an episode that the policymaker has to deal with. And I'm going to argue that ex ante, big data are important because they allow you to monitor household financial fragility. Throughout and during the intervention, the crisis, the recession, they're important because they allow government to design targeted and effective policies. And ex post, they are crucial to evaluate the effectiveness of the intervention and learn about what has been done and to improve future possible interventions. So I'm going to basically organize a presentation around these 3 points, and then very briefly at the end talk about why and whether big data are always superior to survey data. I'm going to give you some thoughts on protocols. Okay, so let me start right away with the ex-ante. So the importance of big data to monitor household balance sheets. So I think I want to start from like the past recession. So one lesson that we learned from the Great Recession was the tight interconnection between household and banks' balance sheets. So there's clearly a direct link. There was a direct link through mortgage contracts and housing markets, but there was also like an indirect, more general equilibrium feedback through the deterioration of bank balance sheets that led to a cut in lending, to lower labor demand, lower wages, more unemployment, and cutting consumption expenditure, and so on. So this tight link between the two balance sheets was one feature of that crisis. Now, a policy response to that crisis, which was very helpful, I think, and very important, was stress test on the bank side. And this was really a useful policy, but also feasible because banks collect big data at their own cost on very detailed data on assets and liabilities, on transactions, and so on. So they have a lot of data to perform this stress test and offer the results to central banks and governments. What I think is equally important in this context, but somewhat absent and missing from the policy debate, is a stress test on the household side. Okay, so basically, the idea of measuring financial fragility systematically and in a very granular way on the household side. And what you need is detailed, high-frequency data on household balance sheets. So you can kind of simulate crisis scenarios and estimate the impact of the shock and possibly inform what I call intelligent design of policy. So not kind of simple policies, but more sophisticated and effective policies. And I'm going to talk mention briefly some ongoing research that I'm doing with economists, a group of economists at the New York Fed on this topic. And in particular, I want to just share one graph, which is one plot, which is this plot of something you can do with this type of data. And you can, for example, you can measure something like the median amount of tappable housing equity in a very granular way, household by household, and you can aggregate in many different ways. Here I'm aggregating geographically by county, and we did it for 2011 and 2019. And clearly, I want to be clear, this is only one determinant of what we call household shock absorption capacity. There are others. Obviously, there is liquid wealth, deposits, savings that households have that are easily accessible. There are limits on credit cards that determine how much also can borrow. This is just one element. But what I think it's kind of interesting to show this plot, because it gives you the idea of kind of the potential of this type of data to monitor household balance sheets. And what you see is that in 2011, essentially right after the crisis, there is a lot of like brown areas. Those are counties, which were counties where households have essentially zero or very little tappable equity. While in 2019, the situation is much better. As you can see, there are a lot more blue areas than brown areas, and this is somewhat good news in light of the current crisis. It means that at least in terms of balance sheets, households are in kind of decent shape. Okay, but these are very challenging measurement with the available data. We know what the ideal data would look like. But they're currently unavailable for the US, but they may be available for other countries. And I think this is an important potential role of big data. Okay, so let me move to the during or throughout the episode. And throughout the episode, I think what big data are useful for is to target policy interventions. So one important role of the government is of providing social insurance, either to credit or transfers to households in need. And one issue is that when a crisis hits, and most crises unfortunately hits without much news, without much alert, there is a certain strong sense of urgency that calls for easy to implement policies. Okay, I mean we are seeing this today, where there's this mantra, sort of get the money out quickly to households, to families, and so what you need are easy to implement policies. But the point I want to try to make here is that easy to implement really is a concept that depends on the available data you have. Okay? So if you don't have data, if the government doesn't really have data available to target and tailor the intervention, you end up with universal policies that potentially have low impact. So unfortunately, I think an example of this is contained in the CARES Act, which is this last piece of legislation that was passed, which has a lot of like very good bits and pieces. But this one is not, I think, particularly good. This is like, a stimulus check that is paid to basically everyone. And so, for example, any family of 4 with taxable income, that's the gross income, less than 150,000 a year gets $3,400. Okay, which is a kind of almost like sort of a lump sum type of transfer. So, if you want to try to make the case that big data would allow you to tailor better the intervention, so you get kind of more bang for the buck, and you can channel financial help to those who really need it. In the context of this particular crisis, I want to give you an example. Okay, so by now you understand that the lockdown has very extremely heterogeneous effects in the population, and the key is whether you are in a flexible or in a rigid occupation. We are very lucky as economists. We are in a flexible occupation. We can do our job from home. We can get paid, but there are many others who can't because of the shutdown, of the lockdown. So I'll give you this example. This is like, I'm using the Dingle name and definition of flexible and rigid occupation based on net tasks, okay? And here are like pairs of occupations that earn the same amount, okay? So kind of, even if you were designing, so the US policy is not even largely conditional on income, but even if you were to condition on income, essentially you would give the same amount to an economist and an optometrist, a secondary school teacher or a flight attendant, a telemarketer or a cook. And these are households, individuals that kind of earn the same amount, but they're hit very, very differently by the crisis, because economists are in a flexible occupation, optometrists they're not, telemarketer are in a flexible occupation, cooks they're not, and so on. Okay? So a transfer conditional occupation, conditional on other information that you have about the individual that are specific, peculiar to the particular episode, to the crisis that you're going through, could be more generous and more. Finally, we think about like policy evaluation. So ex post, after the episode, it is paramount to evaluate the effectiveness of policies. And you can do this in different ways, in various ways. The most straightforward, perhaps, way is to do impact evaluation using, variations of versions of like diff and diff. And here we know, from like over the last like 10 years, that big data are very useful because they improve the design of this quasi-experiment that allow to capture in a very rich way heterogeneous treatment effects, which are really at the heart of policy evaluation. However, one limitation is that they cannot capture this kind of diff and diff approach, cannot capture general equilibrium feedbacks, right? Because those are sort of the intercept that gets differenced out by this procedure. So in the cases of like large interventions, like large stimulus packages and so on, it's crucial to get the size of the general equilibrium effect. So another approach is to do impact evaluation using structural equilibrium models. And state-of-the-art macro models now, they are I think they're in a position of capturing a lot of heterogeneity in household balance sheets between safe and risky assets, liquid and illiquid assets, heterogeneity in preferences and other dimensions, all sort of determinants of heterogeneity in marginal propensity to consume, which is probably one of the key, if not the crucial object to understand the transmission mechanism of shocks and the policy and the response sort of households to the policy. The role of big data here in the context of structural equilibrium models for researchers and macroeconomists is that basically they allow to properly calibrate and parameterize these models and then to test the predictions of the models in order to assess the distributional impact of policy. Okay? The distributional impact of policy assessed here is essentially the counterpart of the heterogeneous treatment effect plus the general equilibrium. Okay. So I want to give you one example of what you can do and why the big data may be useful here, which is in the context of monetary policy. So these would be like big data useful for, say, central banking. So this is an example of a simulation from one of these models that are called Hank models, so heterogeneous agents model with a kind of New Keynesian nominal rigidity structures to get sort of real effect of monetary policy. And this is an effect of the monetary tightening. And what the model allows you to do is it allows you to look at the effect of the monetary policy tightening across the distribution of households, across the distribution of liquid wealth, percentiles of liquid wealth. On the x-axis, on the y-axis, you have the consumption drop. And what you see basically is that the model predicts is sort of this kind of U-shape, if you like, of the effects. Okay, on the high end, you have the standard intertemporal substitution, so the unconstrained households reacting to the partial equilibrium rise in the interest rate and kind of cutting consumption. But on the low end of the distribution, you have households reacting strongly because these are sort of constrained households, hand-to-mouth households, that are reacting to the general equilibrium fall in labor income that is caused by the monetary tightening. Okay, so one question you can address with the big data, which is extremely useful for central banks, is do we see the same heterogeneity in big data, and can we sort of evaluate and test and validate this class of models, and then therefore use this class of models to understand and analyze monetary policy. Okay, so I try to argue that the big data are useful for policy making at kind of 3 stages: ex ante, throughout, and ex post. And I think there's a lot of value in that. I want to conclude with sort of asking an obvious question: are big data always superior to survey data? And I think, you know, there are some clear virtues of big data, which are scale, the fact that they often contain novel variables that are extremely important. Just to mention one example of the Swedish data is like individual stock holdings, and we learn a lot from those type of data about household behavior. Or in the context of the current recession, this sort of mobility patterns, right? With using cell phone data, which are being extremely important to evaluate the impact of the lockdown. They are high frequency, and some of them are real time, which are extremely useful in contexts like crisis like this one. And they are high quality, clearly, because they're less measurement error than survey data. So overall, they allow to truly embrace and measure heterogeneity in household balance sheets, preferences, financial literacy, and so on. There are some challenges, clearly, and I'm going to conclude with this slide, associated with the use of big data that we should keep in mind. One is the representativeness of the underlying universe, because the data, most of them, proprietary data in particular, are not meant to be representative. Coverage is often time varying and is often endogenous to the use. Think about cell phone use, and they're clearly endogenous to the use of the cell phone. But we know, we have a lot of statistical tools to deal with this type of lack of representative sample selection and so on. I don't see that really be a big limitation, just we need to be aware of that. The other issue that I think is also important is the access to the data set that is often restricted. And this has 2 implications. One is that generates some inequality in access, okay? You think about administrative data, what really matters there is the connections, type of connections that you have, unfortunately. And you know, I think there are some glaring examples in the US. For proprietary data, you know, sometimes they're very, very expensive, and so depending on your research budget, you can access or not, and that generates inequality among researchers that I think is not the right type of inequality. It's not based on merit, it's based on other characteristics, like on endowments. So so we should try to avoid that in one way or another. And then the other issue is that, especially with proprietary data, is the replicability of the findings, the reproducible findings are, if data are proprietary, is an issue, and some top journals are trying to deal with that in various ways. Finally, and I conclude, this is a point that that Paolo mentioned at the very beginning. There are these privacy issues. Now, my thought on that is that you know, these are extremely important, but the privacy issues are about protecting the data. They're not an argument against collecting. I think the data should be collected, and then we should put in place a protocol, a series of rules that guarantee protection of privacy. So overall, I think clearly the virtues and the pluses are definitely higher than the minuses, and I'm all for sort of the idea of using this type of data for research and policy making.
Fantastic. Thanks so much, Gianluca. So I would like to move now to Martin Flodén. Please, Martin.
And thanks to Gianluca also. I think your presentation was excellent, and what I have to say is just a small subset of everything that you covered. But I fully agree with everything that you said, and I will talk from a Swedish perspective, and mostly from a policy perspective, since I'm working in the Swedish Central Bank. To begin with, I wanted to say a few words about the term big data and how the Riksbank is working with big data or large data sets. I think sometimes these terms are used in different ways. So if we by big data mean these very non-traditional data that you find somewhere, it's typically processed by some machine learning, and maybe it's a big unstructured data set and variables are not precisely defined, etc. When we think of such developments, the central banks do not seem to be at the forefront of exploiting such data sets or working with them. And I think this is very natural, maybe partly because we have a lot of economists that are not used to working with these techniques in our central banks, but mostly because our type of work and the policy making that we do, it's not well suited for being based on such analysis. So our decisions and our analysis must be very transparent, and we must be able to motivate how we came to a decision and what kind of data we have used and what our models or the analysis indicates, etc. Still, I think such type of work and such data can be very useful also for central banks, but more as some kind of background information. And although it's not at all our main type of data analysis, we have some projects, some in the research stage and some that are actually used also for policy analysis that you could classify as this. For example, we have a number of web scraping projects, mostly to follow price developments, high frequency price developments, and try to be a little bit ahead of the official price statistics that is collected with a lag, obviously. In the recent months, we have also developed and started to follow new indicators, mostly web-based, but also data that we get from non-traditional sources. So we have now a number of high-frequency indicators to try to follow developments under the pandemic. Because the official statistics is lagging so much, so it's not very useful. And some examples here are transactions in different parts of the economy. We also follow, of course, mobility in the society, etc., using data from cell phone operators, etc., as others are also doing. But this is not really what I want to talk about today. I want to talk more about the traditional data sets, and this is really what Gianluca talked about also, I think. So here we could call this large data sets with a lot of information at the micro level, could be at the firm level or at the household level. When it comes to the firm level, we have databases that are being built up and to some extent exploited that are very useful. For example, we now have rather good data, general data on loans and securities, who is holding them, and etc. What are the exposures from one firm or one financial institute to another. And this type of work is being developed not only in the Swedish Riksbank, but it's mostly a joint EU project where different central banks are collecting similar data, so that data also can be compared between countries. I will not focus on this either, but I will focus more specifically on Swedish households and what we would want to have. And this is detailed data on household or individual wealth and liabilities. Let's see if I can move on. And actually, we did used to have such data. It was extremely detailed and useful. Data was collected from 2000 to 2007. Annual data for each individual, actually in Sweden, each taxpayer. The tax agency collected detailed data on household balance sheets, basically. All assets, specific assets, down to the particular stock that was held, etc. And liabilities. Also real estate, although the valuation was sometimes a little bit tricky here. Unfortunately, when the wealth tax was abolished in 2007, data collection also was terminated. At the Riksbank, other policymakers and the research community in Sweden has been rather disappointed about this, and the Riksbank has formally asked the Swedish Parliament to actually resume data collection or to allow Statistics Sweden to again start collecting such data. We have support for this requirement or request from Statistics Sweden and also from the Swedish financial supervisor, the Finansinspektionen. And I will illustrate a little bit why this is so important to have access to this data from the policy perspective. And this comes precisely to the type of question that Gianluca mentioned. We want to understand vulnerabilities in the household sector. Obviously, from a research perspective and in the long term, research also has implications for policy. There have been a large number of important, I think, and very interesting research projects. I think Paolo, for example, and John have used this data to look at financial sector implications. I have myself participated in a research project where we used the data from 2000 to 2007 to try to understand heterogeneous impacts of monetary policy through what we call it the cash flow channel. That is households that have different balance sheets, different holdings of assets and liabilities. Are they affected differently by monetary policy in an important way? I think this is very important because it would say something about how monetary policy, the impact of monetary policy can change from situation to situation if the aggregate balance sheets in a country or the balance sheets of households changes as they have in Sweden. So should we expect monetary policy to work in a similar way today as it did 10 or 20 years ago, for example? I think there are good reasons to think that it should not, because households have so different exposures and the cash flow is affected in different ways today relative to 10 or 20 years ago. And to illustrate these changes, this is a graph that the Riksbank often shows. It shows household debt as percentage of household disposable income in Sweden. And as you see, over the last 25 years, household indebtedness increased from 90% to more than 180%. So households have much more debt, mostly mortgage debt today than 25 years ago. And the Riksbank has consistently for the last at least 15 years warned about this development and said it indicates that households are becoming more and more vulnerable to different types of shocks. And that's, I think, rather likely if you just look at this graph. And some people in the Swedish debate have agreed with our assessment, but it has been a very lively debate where also a lot of people do not agree, and they tend to start from graphs looking like this. So in the left panel, the blue line is still the same as the one I showed, But if you look at household wealth instead, and here the red line is household financial assets excluding pension savings, so it's only other types of financial assets. Wealth has also increased and rapidly increased and more than doubled as a fraction of disposable income. An alternative way to see this is to look at the right-hand side panel, household savings. The Swedish savings ratio is very high, both in a historical perspective compared to what it has used to be in Sweden and also compared to other countries. So this indicates that, well, maybe households in Sweden have a lot of debt, but they have even more assets and buffers to handle or withstand a downturn such as the one that we're seeing now. But clearly, households are heterogeneous. So the question here is: the main question from the policy perspective, I think, is it the same households that accumulate assets as also hold a lot of mortgage debt, or for that matter, consumer debt that has become more and more important? Up until 2007, we could analyze this and, for example, produce a graph like the one shown here, which shows that young households, on average, they don't have a lot of financial assets, but they have a lot of mortgage debt, not surprisingly. But as you get older, you accumulate more and more assets, and then you tend to repay part of your debt. Or maybe you were not as exposed to high house prices when you were young. You didn't have to borrow as much as young households have to today. I think looking at this graph indicates that Swedish households, there's a large group of Swedish households that are actually very exposed if you look at their balance sheets. So exactly as Gianluca said, it's difficult to assess vulnerabilities and risks if you just look at aggregate data. It's difficult to calibrate and to target macroprudential policies if you want to address these risks. And obviously, there are many other dimensions in which households are heterogeneous. So if we understand that households are heterogeneous in important ways, it is important for us to be able to collect data so that we can analyze this type of heterogeneity. This is important for research to make progress, and it's important for policy decisions to be well informed and precisely targeted. That's everything that I had to say as an introduction, at least. So thanks.
Thank you so much, Martin. It's really nice to see concretely, some examples of why this could be very important for policy, for financial stability and for macro policy. Now I would like to switch more kind of to issues of optimal pension design, or get more into micro type of issues, and I would like to give words to John Campbell. Please, John, the floor is yours.
Okay, thank you very much, Paolo. Let me now try to share my screen. Great. Okay, so this panel is about household welfare. Do we need big data? As previous panelists have mentioned, big data is perhaps a little bit of a sloppy term that's used in different ways by different people. But I think what we're primarily talking about here, and what I'll talk about, is large administrative data sets that go down to the level of individual households and that have comprehensive coverage in the whole economy, as well as detailed content. So this is what distinguishes big data in this sense from traditional survey data. These big data sets are sometimes public in Scandinavia. Martin was talking about the Swedish wealth tax data. In other countries, such as the US, they tend to be privately provided. Think, for example, of the data held by the credit bureaus or the large mortgage data sets that we work with when we study the US mortgage system. So do we need these big data for household welfare? My answer is yes, of course, no surprise there. I'm going to highlight three possible uses of big data for policymakers. And the first two we've already touched on, earlier panelists have covered. I'll say a few more words, but then try to move on to the last one. So the first one is what I'll call disaster relief. And we're living through a disaster now, the COVID-19 crisis, and households have heterogeneous resources. And it would help, as Gianluca said, it would help to be able to measure that in much greater detail. We can think of this as a financial public health effort, analogous to the type of work on medical public health, universal testing, and so forth that people are talking about today. The second kind of use we've also talked about, both Martin and Gianluca were emphasizing that when we go through a recession, if the monetary and fiscal authorities are trying to manage aggregate demand, they need to be able to understand heterogeneity in household responses to stimulus. And then the third topic, which I'll try to introduce to the panel, is that when we think about financial regulation from a consumer financial protection point of view, it's very important to understand heterogeneity in both household tastes, what they would like to achieve in financial markets, and also their capabilities, their financial literacy, their skills, their cognitive biases, and so forth. So first of all, disaster relief. It's wrong, I think, to think about the COVID crisis in terms of demand stimulus at this point, because it's both a demand shock and a supply shock. But the immediate short-term priority is to ensure that everyone in the population has adequate spending power. I mean, we can motivate that by going back to Amartya Sen's famous work, in which he pointed out that in famines, the thing that causes starvation is not a shortage of food supply at the aggregate level, it's an absence of spending power for certain people in the population. Now, we know that many people, even in wealthy economies, lack emergency funds. There's a very well-known finding from Fed surveys that in 2013, about half the adult US population could not cover a $400 unexpected expense with either cash or formal credit, such as credit card borrowing. Now, things have improved a little bit since then. That fraction has fallen to 40% in 2018, but still, this is pretty alarming when you think about the impact of a crisis like the present one. Of course, to target relief, we need to know both who suffers an income loss and who lacks emergency funds. And if we don't have that information, as Gianluca pointed out, we use crude policies like the one in the CARES Act. Now, moving on to aggregate demand management. In a normal recession, what fiscal and monetary policy are trying to do is to stimulate aggregate demand. We may, of course, reach that stage in the current crisis as well. And there's a huge literature in macro on the channels of transmission, which go through business investment and household consumption primarily. If we focus on the consumption channel, the effectiveness of this channel is going to depend on the marginal propensities to consume of households. And the modern macro paradigm, as Gianluca emphasized, uses a canonical model with heterogeneous households who have random income that evolves over the life cycle. They have borrowing constraints, and then they hold assets, which increasingly models consider multiple assets that may be safe or risky. They may be liquid or illiquid. And the result that comes out of this literature is that the marginal propensities to consume depend sensitively on liquid asset positions, which in turn depend on fundamentals such as age, the history of the shocks you've been exposed to, both in your income and in your financial asset and housing holdings, and also on your preferences with regard to time, your impatience, and your risk attitudes. So if we're going to calibrate and apply this framework, we have to be able to measure MPCs or their determinants and then feed it through the model to get those MPCs. Now, I'd like to focus in a little bit more narrowly now on the mortgage channel of monetary policy, which has been the focus of a lot of research, given the central role of mortgages in the downturn of 2008, 2009. So we know that one channel by which monetary policy can affect aggregate demand is by changing the mortgage rate. In countries which have adjustable rate mortgages, or ARMs, the pass-through is pretty direct. It just depends on the short rate. It occurs automatically. Borrowers get budget relief, their monthly payments fall. Of course, even here, the demand effect at the aggregate level is going to depend on the marginal propensities to consume of borrowers relative to lenders. So we still need to have that detailed data on borrowers relative to lenders. In addition, I've been doing some work with Nuno Clara and Joao Coco on further adjustments to adjustable rate mortgage systems, for example, adding mortgage payment holidays in recessions. And this is something that's actually been happening to some degree in the present crisis. Now, in a fixed rate mortgage system like the US, like Denmark, like Germany, the pass-through depends on the long rate, and it's going to require borrowers to refinance, which they can do in both the US and Denmark. Long-term payment relief from a fall in the mortgage rate is going to stimulate consumption approximately 1-to-1 for permanent income households, possibly more than that for constrained households whose constraints are relaxed by lower mortgage payments, because they're going to be able to borrow more and consume the extra borrowing. But in the US system, in order to refinance, you have to have adequate home equity and a good credit score. And so we'd like to know which consumers are able to take advantage of lower mortgage rates to get that budget relief. An obvious point is that the effectiveness of monetary policy is then going to depend on the distribution of house prices. And in a large country like the US, there's going to be regional effects. You're going to be lucky, for example, if house prices are high in those regions that are most depressed and need the most relief. But unlucky if, as in 2008-9, the most depressed regions also have the lowest house prices. Now, beyond this, there's also behavioral heterogeneity in responsiveness. So slow refinancing isn't just the result of constraints. We know, for example, that borrowers are slow to respond even when given pre-qualified refinancing offers, as Keyes, Pope, and Pope have pointed out. And in work that I've done with Stefan Andersson, Kasper Nielsen, and Tarun Ramadarai, we document that there's quite slow refinancing in the Danish fixed-rate mortgage system, even though that system has no barriers to refinancing that reduces your rate. You don't need positive home equity. You don't need a good credit score. You have the right to refinance, but people still do it slowly. And there's fascinating heterogeneity in the effectiveness of refinancing. So this is a figure from our paper. The vertical axis shows what we call refinancing efficiency, which is the fraction of savings during our sample period in the early 2010s. It's the fraction of savings that people achieve relative to what they would have achieved if they'd followed an optimal refinancing rule that we apply from the academic literature. So on average, that refinancing efficiency is something like 2/3, 65%. So people are not getting all the savings they would do if they followed an optimal policy. But what the figure is showing is variation in that number across the distribution for various demographic variables in Denmark. So the line with X's is age, and that slopes down, showing that elderly people refinance less effectively. The circles, that's education. More educated people refinance more effectively. The diamonds is income. Higher income people refinance more effectively. And finally, the squares, that's housing wealth. People with larger houses refinance more effectively. So we can see that the mortgage channel of monetary policy is going to have different effects across the distribution of all these variables. And that's going to be relevant for the monetary authority. Now, beyond this, this is going to be relevant for financial regulation and consumer financial protection. And I'm going to turn to that theme now for the rest of my time. I want to raise the issue of cross-subsidy. When some households in the economy are able to use a product such as a fixed-rate mortgage effectively, while others are not doing that, the result in a competitive market is going to be a cross-subsidy from the unsophisticated users to the sophisticated users. Why? Because mortgage lenders compete for the business, and the extra profits that they get from the naive borrowers who don't refinance, that gets competed away in the form of lower mortgage rates up front. So the winners actually are going to be the richer and better educated people who know how to refinance. And this has distributional consequences that I think should concern us. In addition, cross-subsidy can inhibit the development of better products. So you might ask, why do we make people solve this complicated real options problem and figure out when to refinance their mortgage? Why don't we have self-refinancing mortgages that just operate automatically? And it would save a lot of cost. The problem is that a firm with a new product, a self-refinancing mortgage, can only sell it by educating consumers and explaining the problem. But any consumer who understands the problem will also understand that the existing product is great if you know how to use it. So once educated, they won't buy a self-refinancing mortgage. So my colleagues Xavier Gabex and David Leibson have the canonical paper on this, where they talk about shrouded equilibrium of this sort. And if the economy is in a shrouded equilibrium, that may justify financial regulation to eliminate the cross-subsidy. But we wouldn't want to undertake that kind of intervention in the economy without being able to measure the extent of the problem. And here is where I think big data is once again useful. Now, more generally, I would argue that the extent of financial regulation for consumer financial protection ought to depend on two types of heterogeneity. Heterogeneous tastes should make us cautious about regulation, and particularly we should avoid one-size-fits-all regulation if people have very different preferences. On the other hand, heterogeneity of financial capabilities should make us more aggressive in regulation to protect the unsophisticated. So Martin mentioned the Swedish administrative data from the early 2000s. I've been working on that with Laurent Calvet, Francisco Gomez, and Paolo. And, our findings are, we look at middle-aged Swedish households saving for retirement, and we find a lot of heterogeneity in their rates of time preference and elasticity of intertemporal substitution, and quite a bit of heterogeneity also in risk aversion. And so that type of big data is helping us understand how much heterogeneity there may be in terms of people's attitudes. On the other hand, if we look at financial literacy test data, we find that there's also a lot of heterogeneity in financial capabilities and also in people's confidence in their own abilities. Now, this type of data is actually survey data, because in order to get into people's heads, you have to ask them. So there's really no alternative there. But this is a chart from my Ely lecture that I gave in 2016. And it shows the distribution of financial literacy test results across two genders, men in blue, women in red, and different age groups, with the youngest at the left and the oldest at the right. And the bars show the incidence of low literacy. Low literacy is a score on 5 literacy test questions that is less than you would get if you guessed randomly. So it's pretty low. And the high fraction of illiteracy is very concerning, particularly among the young and the most elderly. There's also a gender gap that should be concerning. And finally, the strong colors, the dark red and blue, indicate the group that is both has low literacy, but at the same time has high confidence in their own abilities. So there's a lot of heterogeneity. And this raises the question, how much financial regulation? Senator Elizabeth Warren made her start in politics with her work on consumer financial protection. And she wrote a famous article where she pointed out that you're not going to be able in the US to buy an unsafe toaster that will burst into flames like the one in the picture. But she pointed out that you could buy an unsafe mortgage that would get you out of your house just as effectively as a flaming toaster. And she then argued, why don't we just ban a lot of non-standard mortgages just the way we ban unsafe toasters? Of course, this analogy, while very colorful, relies on the assumption that basically households are identical. In the toaster market, we all want the same thing from a toaster. So a strict regulation that enforces uniform standards on toasters is probably warranted. But in household finance, this is not always true. And I think we need big data, high quality microdata to properly calibrate financial regulation. So my last slide sort of illustrates that. Along the top, we have variation in consumer preferences from homogeneous at the left to heterogeneous at the right. And on the left vertical axis, we have the level of consumer sophistication from low to high. And the box shows various types of financial products that might be more or less strongly regulated based on this type of variation. So if you have a stored value card, a debit card that you pick up in a store, in a convenience store, that is used by fairly unsophisticated people. The product is pretty homogeneous. People want the same thing. So it's in the bottom left. On the opposite extreme, if you think about people buying hedge funds, they have to be qualified hedge fund investors, so they're more sophisticated, and people want many different things. So that's in the top right. Mortgages and credit cards are sort of in the middle. And unfortunately, in those cases, there's a wide range of sophistication in the clientele. But ultimately, we want big data to understand where different financial products fall in a conceptual diagram like this, and in order to be able to design targeted financial regulation that's going to effectively address the problem without enforcing too much homogeneity on consumer financial markets. So let me stop there. Thank you.
Thank you so much, John. Thank you so much. So now from macro to more micro and consumer protection issues, and now we can't have an event like this without thinking about what happens inside big banks and how they use their data. So Shiler, Khedri, please, the floor is yours.
So far, I think following the conversations, we have well established that we do need data, we do need big data, and it's kind of in the heart of everything we do in the financial services. So I will more focus on, now that we have established the need for data, what are the requirements and what are the technology infrastructure toolings and the core ecosystem that needs to be put in place in order to make these data useful and create insight out of it for the financial industry. So with the rise of data and technology being used within financial services, two types of policies will come in mind, and there is sense of urgency to establish these policies. One of them is policy on regulating the use of technology and data and AI and consuming data, and one of them is making policy through the use of AI, data consumption, and technology. The first one, which is more focusing on regulating the data consumption throughout, and whether it's statistical modeling or traditional modeling or advanced AI or machine learning or deep learning, it is the protection of individual rights. And there has been a lot of work going there, which I'm not going to talk about, which ended with GDPR and implementation of GDPR within Europe to protect the individual's privacy. But another topic that is very important in the data consumption within financial service is the ethical and morality side of data consumption. And that's where we need to be mindful and very careful about how we are bringing data together, because we may be very well legally compliant because we have consent from customer to use their data. We have basically governmental blessing and public blessing to use these data. But when different data comes together and we use this algorithmic approach, they may very well produce outputs that morally is not okay, and we are not in an ethical right side of the ethics. And to give example, data holds a lot of historical bias within the DNA of the information. And because within the data consumption and the algorithmic approach or modeling approach that we are using to consume these data for the purpose of different purpose within financial services, we may unknowingly be biased for producing biased outcomes. And giving example, for mortgage pricing and mortgage, there is neighborhoods in a cities that historically in the past been not very well neighborhood or a criminal neighborhood, or for whatever reason it's been in a high risk when it comes to credit risk, when it comes to mortgage and existing. And recently in the last 30 years or 10 years or 5 years, it is an underdevelopment area and starting to change, and more middle class and more reliable households are residing in those neighborhoods. So when we are using these data in our policy making, whether this policy is decisions or strategy or public policies, then we may very well discriminate against individuals and households living in neighborhoods. That's why ethics is becoming more and more important on consuming data and big data within financial services. The other one is more about permissionless innovation within financial services. And we are intent to go very conservatively when we are defining these policies to regulate data consumption within financial services, because we feel more comfortable being in the safe side. However, that's where we need to allow the second type of policy, which is making policy through use of data and technology to enable us to basically expand opportunities and create better insight by use of data without a lot of constraints and limitations. Just like we are having a good faith in the natural intelligence and humankind, we do have to have that toward artificial intelligence as well and the data consumption, because and then unless we are proven otherwise. So we can enable this permissionless innovation within financial services. But most importantly, policy through the technology and data consumption. And this is where ING has invested heavily on different, I think around 9 business lines on how to consume data and how to consume technology in order to set policies, decision makings, and strategies. Whether it's a financial crime for AML and KYC, or is risk and pricing for mortgage pricing, or any risk, credit risk, or anything similar, or customer intelligence, whether when it comes to hyper-personalization for households and individuals, so and on and on and on. So that's why the mortgage pricing, which John was, for example, also talking about, and mortgage in general, is a very interesting topic. Why big data is very, very important and useful, because as the volume of data is increasing and the more and more micro and high frequency data is becoming available, we are able to use more self-learning systems that enables us to adapt to different situation and circumstance. And this could be very well the current circumstance with COVID-19. If we look at the traditional model risk and traditional risk modeling, we may now very well be in a biased outcome because the circumstance has changed, the parameters may change, but using these self-learning and big self-learning systems, whether it's machine learning, deep learning, or any other approach, and big data enables us to learn from the circumstance and be able to through the online learning be able to update our models and hopefully be in more unbiased situations. So another important thing is the availability of data to policymakers and to decision makers, but as well as staying in forefront of academic advancement and development. And that's where ING is heavily investing on collaborating with academic and universities through different innovative lab and establishing AI for FinTech Lab, which is focusing on 10 research tracks and supervising PhD students throughout these research tracks to enable them to resolve the upcoming challenges, open issues, and open problem of using data, and how we can overcome these challenges on day-to-day businesses by consuming data within financial services. So in general, the use of data is not new to economic and social, quantitative social sciences, although it picked up a lot of traction. But we've been using mathematical approach, statistical approach for many years, and indeed using the use of data. But what is important and is novel at the moment is the availability of a really vast range of a wide range of data being available to financial industry, and how and the type of relations that we can model and the correlations that we can extract out of these wide range of data. It is what is new to basically financial services and the banking or any other vertical of it. So I will finish with these slides, because we talk about all these data and AI and everything that needs to be used within financial services, but it takes a lot of work by banking system and financial service to enable these data consumption, and that is through the very comprehensive technology, data and technology ecosystem, from ingesting data, acquiring data, preparing data, governing data, to the development, whether it's exploration and to exploitation via very governed production pipeline. Because we intend to, in the research side of financial services, we do a lot of work and a lot of engagement on exploring and developing methodology, but operationalizing those methodology, those research into actual decision making, it is where the most value resides. So I will stop here in respect to the time, and then give it back to Paolo. Thank you.
Thank you so much, Shiler. So let me now give word to Carolina Ekholm, professor at Stockholm University, also previous deputy governor at Riksbank, and also undersecretary to the Ministry of Finance, previous undersecretary of the Ministry of Finance. So I would like to thank you, Carolina, so much for helping me on setting up this whole event, and for agreeing to moderate the panel.
Thank you, Paolo. And thanks to all of our panelists for very interesting presentations. I should remind the so-called audience, the other participants, that you can send in questions through the Q&A function. If you have any, and I will try to, maybe with the help of Paolo, to collect them and see if we can get our panelists to answer them. As Paolo mentioned, I have a past in the world of central banking, so actually my own interest in this issue dates back to that time. I was a deputy governor at the Swedish central bank between 2009 and 2014. So I was there in principle when Sweden was hit by the global financial crisis. And of course, at that time, there was a strong feeling at the Riksbank that one would need detailed information about how the Swedish households were affected by this crisis. But as Martin explained in his presentation, we haven't really collected information about household assets in Sweden since the abolishment of the wealth tax in 2007. I thought, naively probably, at the time in 2009, that surely everyone would see the need for restarting collection this kind of information. But that was not so. We ended up having quite a lot of opposition to collecting this information again. But as Martin explained, there is now some sort of process that could potentially lead to collecting information about household balance sheets again in Sweden, which would of course be quite helpful and welcome. As several of you have pointed out, we are being hit by another crisis now. It's not financial in its origin, but it is sure to have financial implications for households as it affects asset prices and employment prospects and public finances. So I thought I would, before looking if there are some other questions coming in, I wanted to ask maybe primarily Gianluca and John something about big data and the response to this crisis. So you both talked about how big data could enable us to tailor policy intervention to channel help to those who really need it, and get more bang for the buck. I think that was Gianluca's way of expressing it, which of course, I, with my background at the Minister of Finance, of course, you're always looking for getting bang for your buck. But one question that I wanted to ask is, I mean, also Gianluca compared households to banks when discussing stress tests. And of course, with banks, we do this test in order to really try to see which institutions need potential bailouts, something that we're not very keen on giving, but we do it in order to not end up in a worse situation. But we're not keen on doing it because of moral hazard issues, for instance. So I wanted to ask you, do you see some analogy to this when it comes to looking at households at a detailed level to target financial help for households, and maybe to put a little spin on this question? I mean, do you think that in principle you might end up wanting to have some sort of capital requirements enforced on households?
All right, so these are, I think, they're all great questions. Let me try to be brief. So first of all, I want to start from the discussion about the data collection in Sweden. Maybe I can give you one example where I think it's really important, and then make a point about the argument, what I think are the argument against data collection. And I don't know the details of the debate in Sweden, but I think they're pretty much the same arguments in every country. So I was first thing is that I find very interesting. I was talking to, emailing with Roine Westman, who is probably connected. I imagine is listening to us. Who is a professor at the University of Stockholm and an expert on household finance and macro. And he was telling me that one thing that has happened in Sweden with respect to the data is that right now, basically, you can't compute anymore the distribution of households' deposits, basically, of households' liquid wealth in the Sweden population, because the way to do it, if I understand correctly, was basically a sort of capitalization approach starting from interest payments on bank accounts. But my understanding is that there is a threshold under which interest are not reported, which is a certain threshold, and as interest rates basically are approaching zero, nominal interest rates are approaching zero or even becoming negative, then essentially a bigger and bigger portion of the population, for a bigger and bigger portion of the population, these data are not available anymore. And this is sort of was related to the point of that I made earlier about the coverage of administrative data sometimes being time varying and endogenous. I think this is obviously a big problem, because precisely at the time where it is important to understand what is the actual distribution of liquid resources available at the household level, so the resources the household have and are easily accessible to cope with shocks, it's a time at which you cannot make this calculation because the data are not available. So that I thought will be a strong argument, to try to get this type of information in a different way. With respect to the arguments against data collection, I think privacy is obviously, I imagine, is one of the arguments, but I'm not an expert, so I don't want to discuss that particular issue. But the other one must be certainly like cost. It's costly, and resources are perhaps better used somewhere else. So I think with this respect, it is important perhaps to be able to do this type of sort of counterfactual calculation, where you say, look, if we had this data, we could achieve exactly the same effectiveness of the policy by spending X% less. So this is the amount you would save every time if you had more data. And in order to collect data, the extra resources, funds that you need are much, much lower. And so overall, the sort of simple cost-benefit calculation is definitely in favor of collecting data. So I think this type of calculation will probably resonate positively through policymakers and parliament and so on. Going to your second question, which was about the type of policies, what extent sort of big data will be useful in this crisis, in this particular crisis. I mean, I think that I really liked a lot what John said in one of his slides, where the type of information that you need has to be very granular, because you need to understand who is hit by the shock, and at the same time you need to understand, among those who are hit by the shock, the ones who do not have, the ones who are financially fragile, the ones who do not have the funds to cope with it. Okay, and that requires obviously a lot of data, because in this particular episode, it requires very detailed data on the type of occupation and the mix of occupation at the household level, and it requires obviously a knowledge of the vulnerability of households, which is a complicated measure, because it is basically an object that has many inputs. It has holdings of liquid wealth, your credit card debt, your limits on your credit card, your home equity, and whether you're able to access your home equity. So it needs a lot of information, and only very large and granular administrative data set would be able to offer that type of information. Your last question was about this kind of household stress test, and you're asking me whether you think that there should be something like capital requirements imposed on at household level. Well, I'm not an expert on financial regulation, so I would pass this question on to John. But in some sense, there are already these type of requirements, and when you apply for mortgages, there are loan-to-value ratios, debt-to-income ratios that apply. My sense is that this type of kind of stress test or calculations to understand the financial vulnerability of households is more sort of to prepare. It's more sort of to be ready to understand and analyze exactly what a shock of a certain magnitude can mean, and so the type of resources that the government needs to deal with that. And then I don't know whether one can go one step further and say, well, there are these type of data tell us that there are a certain share of households that are extremely fragile, and so we need to intervene somehow to protect them. But again, I think I would pass on the question to John, because he has explained very clearly that the policy design is very complicated because there are different dimensions of heterogeneity that play a role. So not just the household balance sheet.
Well, I mean, you bring up, Carolina, you bring up obviously a very important issue, which is any kind of tailored assistance is functioning a little bit like insurance, right? It's providing a payment to those most affected by a crisis. So it's like an insurance policy. We know anytime you're providing insurance, create the possibility of moral hazard. And that's a concern. That arises with conventional policies like unemployment insurance. But of course, my suggestion that one should be trying to measure asset values is in effect making the insurance policy means tested. And anytime you're means testing, you distort the incentive to save and so forth. So I think, you made the analogy of capital requirements for households. I would perhaps say it a little differently and say that if we're going to extend public insurance provision, that then what comes along with that, whether you're getting a private policy or a public policy, is that you have to submit to some requirements that the insurance provider imposes upon you in exchange for the insurance. So I think there are some possibilities. I mean, let me just throw out some ideas here. One is that we might use the tax-favored retirement accounts that people in most developed countries have, defined contribution retirement accounts. Those are illiquid by design. They are intended for retirement. But you could imagine a system in which, upon the occurrence of a disaster, and in a targeted fashion, people are given access to those funds on an emergency basis. Similarly, a related problem arises with small businesses, and how do you protect small businesses through a crisis like this? It turns out that their existing relationships with banks and insurance companies are absolutely vital. If you're going to get funds through to the small businesses, the government is not well equipped to do that directly. They have to work through financial intermediaries. So in the US, they primarily work through banks. Meanwhile, the insurance that small businesses have, many of them have what's called business continuity insurance, which is intended to protect them in the event that they get shut down. Well, it turns out in the fine print of those policies, there's a pandemic exclusion, and the private companies don't want to write that insurance. Why not? Because it's very systematic. It's therefore very expensive for them to provide. But it seems to me here is an opportunity for a private-public partnership. You could have the government providing that component of the insurance for a fee, just the way the government, for example, in the US guarantees qualified mortgages. They are in effect selling mortgage default insurance to investors. And by channeling it then through the more general insurance that small businesses have, you ensure that the plumbing is there for the funds to reach businesses when they need it. So you might need to require that businesses, as part of their business continuity insurance, that they sign up for this emergency or pandemic protection, which then is actually ultimately provided by the government in exchange for a suitable component of the premium. So I think in other words, what I'm getting at is I think we need to think of this as an insurance design problem, and we have to be aware of all the difficulties that arise in insurance markets, which we've understood at a theoretical level since the 1970s. But you know, in the modern era, with the data that we now have, we're able to make those models much more empirical. And you know, big data is very useful for this kind of insurance design problem now. And I think that'll be actually a hot area of research after this crisis is over.
Very interesting. So thanks. So there are a lot of questions coming in now, so it will be quite difficult to select the right ones, and given that we're already running on overtime, so I probably won't get to all of them, but I have one here. Would it be possible to design a general model or template for ideal registry-based data, big data collection that safeguards privacy and also keeps data at arm's length from political involvement? What would such a model include in terms of technology and in terms of legislation? And from your perspective, which country seems to have the best model in place at this point? So there were several questions and maybe not so easy to answer. But since I see that Martin, he looks way too relaxed, and he's, yeah, so I'll give the screen to yours. The screen is yours, I guess, will be the new phrase in this online meeting world.
Thank you, Carolina. Although I'm not sure that I can answer that type of question with any valuable insights. So I think to actually set up the ideal framework is to have a too high ambition. And several of the panelists and the questions have also raised the issue about privacy. I think at least here in Sweden, privacy is not an enormous obstacle that we have to overcome. In Sweden, we have, for some reason, a tradition of handing out a lot of data about ourselves and accepting that at least public authorities know a lot. The tax agency and Statistics Sweden, they collect a lot of data about individuals, and the tax statements, for example, they are publicly available, so you can ask the tax authority to have the tax statement of any individual handed out to you. And that type of information is not at all necessary for the type of databases that we want to see. We are not interested in particular individuals. So the data, of course, should be anonymous, although contain information about specific individuals. We don't have to know who is the individual. And that can be handled already by the systems that Statistics Sweden have in place. I think Statistics Sweden, we have a lot of trust in them. And when I say we, people in Sweden in general, they have already the routines for collecting data, to anonymize data and process big microdata sets and handing out the relevant parts anonymized to different researchers or to different agencies in Sweden. I'm not sure this answers the question, but I think that is the way forward, at least in Sweden.
I just want to say that actually the system we used to have to collect the data up to 2007 is absolutely in place. They just deleted a few variables. So this kind of goes to the question of whether it could be very expensive compared to survey data. We have a system in place. It collects a lot of variables. Most of the variables we used to collect, but some of them not anymore. And I don't think it would be extremely costly to just add those variables back. But the system itself is still alive and kicking in a way. So that's actually useful to keep in mind when it comes to the Swedish case. And also, when it comes to the question of ideal system, maybe I completely agree with Mark, it's difficult to talk about what is ideal here, but the other Nordic countries still collect wealth data. In particular, Denmark has decided to abolish the wealth tax, but keep collecting the data, which is, I think, very useful for them in terms of policy, both at a macro level and for consumer protection. Can
I add something to this?
Absolutely.
Yeah.
Please.
I mean, confidentiality is an important thing, but if we're comparing, these administrative data to survey data, there are many dimensions in which, this is easier, right? So first of all, people trust their banks in the sense that, they let their banks know how much they have in those accounts, how they operate. These banks already have, these data. Secondly, you have, if you compare to survey data, you have a central bank coming in asking you what you own and what you owe. Who knows what they are going to do with this thing? Here, just send John Campbell along to explain to people that, they can be insured, then when bad things happen to them, they can get compensated, etc. Right? So we are on a much easier, in a much easier framework. And if you think that even in the Swedish data with the wealth tax, there was acceptance, political acceptance to be collecting these data to tax people, right? William Bowter used to call it legalized theft. If people are happy to be, taxed and to give their consent, why not give their consent to build this database for other purposes, for insurance?
Perhaps I can just jump in and say, the Scandinavian countries have a enviable level of trust in society at large and trust in government in particular. And in the Anglo-Saxon world, that trust is much weaker. What's remarkable to me is how many people have been quite content to let their data be collected and processed by big technology companies, by credit bureaus, Equifax and Experian, and people have not paid attention to this. Now that's changing, actually. People are becoming more worried about the technology companies. It'll be interesting to see whether in the wake of the COVID crisis, whether attitudes towards public use of data shift in the Anglo-Saxon world. I would love that to be the case. I don't know how optimistic to be, but it's certainly possible. I don't think, unfortunately, there's any alternative but to have a high level of trust in society in order to gather and use these data. It's just a requirement for that to happen.
I'd like to add something, if it's okay. But it's also our own contribution as a financial industry on making transparency for individuals and households that how are we consuming data. In some of the other industries like healthcare and maybe other industries, there is more activity from the people involved and in the core of industry to basically clarify the how and the why of data consumption and creating that transparency needed for individuals to give those consents for insurance companies, for banking system, for anybody else to use their data in more extensive level. And I think that's where explainability and those fairness context becomes much more important for individuals to provide consent.
Thank you. And let me also add something. I think, John, you have this great quote from somewhere when you've said that it may be more unusual today for people to reveal intimate details of their financial affairs than to reveal details of their intimate affairs. I guess that's the kind of Anglo-Saxon people being very open with what the aspects of their private lives on Facebook and so forth. And I share your hope that maybe this crisis will lead to a change in me being more open to actually share information about financial issues with the authorities.
I think I mean, from the point of view of sort of household finance data, I think, you know, if there is the will from the point of view of the government or the institutions to collect data and sort of build a large, rich administrative data set, then there are lots of ways to collect accurate data on household assets and liabilities. You know, in the US would be through credit bureaus, financial institutions. You know, whether you have the wealth, when you have the wealth tax clearly from tax records and so on. I think what is more challenging, it is sort of the frontier, and it would be, I mean, extremely useful to inform macroeconomic models, but I think also like policy evaluation is consumption expenditure data. Because right now we are essentially, you know, as economists, even with the best possible data, like the Norwegian data, the Swedish data, and so on, what we do essentially, we do some accounting from the household budget constraint where we have all the other items at the household level, and then residually we back out consumption expenditures. But it's obviously, that becomes very noisy. There's a lot of error, a lot of questions, a lot of issues of measurement and so on. So I think ideally, you know, transaction level data on expenditures would be really sort of the, you know, the cherry on the cake. And I know that, you know, the Statistics Norway is making some progress in that respect. I think they are at very early stages, but they are sort of trying to combine data, this type of data with the registered data. And obviously the advantage that Norway is pretty much a cashless society, so you know all transactions are by card. This would be much harder in other countries in say Southern Europe, like Italy, where cash transactions are still very much common. But I think that's sort of the kind of the new frontier in a way.
I totally agree. I mean, I think also, I mean, in this crisis, I mean, I've seen some of the financial institutions and credit card companies. I mean, they have provided information about consumption transactions that have been quite helpful in identifying which particular specific industries have been hard hit by a decline in demand and sales. So I perfectly, I mean, I think that's a very important and good point. Time flies. I mean, it flew very quickly. So I think we have to start to wind down. So we are reaching the end and we have gone over time, but I'd like to thank you all for participating. I think this has been extremely interesting. I feel more optimistic now. I became so downtrodden when I was at the Riksbank trying to push for this, the need to collect this data and kind of hitting a brick wall. But I feel reinvigorated. So thank you all, Gianluca and John and Martin and Shiler. And I think I'll just hand over to Paolo to perhaps close the event for today.
Thank you so much. This has been fantastic, actually. I think it's very important that if people start to understand the advantages of the collecting this type of information, as they do in their immediacy when they can access Instagram or Facebook and so forth, they will be more willing to share more information or accept that more information can be shared. And I think also the collaboration between the private industry and the governments is something to be exploited. For example, on expenditures data, the best way to do it is to have credit card data, and that's what banks have. In fact, I like a lot Michael's point. You know, banks have a lot of information. A lot of information is handed out already. John's also mentioned this, and I think it's like. It's really when you see the advantage of it that you understand it would be important. And I think, Gianluca, you're perfectly right. Is not about whether we should collect it, is how we should collect it and how we should actually preserve and make sure that is not misused in any way. Okay. Anyway, I was looking forward to this. It went even better than I expected. So thank you so much to all of you. Thanks a lot.